be looking at the definition and the need for auditing. The definition for auditing and the need for auditing. At the end of this session, these are the objectives that must be achieved. You should be able to define and explain auditing, explain the objectives of auditing, and explain the advantages and limitations of auditing, and describe the structure of an auditing firm. So these are the objectives that must be achieved at the end of the lecture. Definition of auditing. Auditing is a process carried out by an appointed qualified person or body whereby the records and financial statements of an entity are subjected to independent examination in such details as will enable the auditor form an opinion as to their truth and fairness. And this definition is coming from the International Standard on Auditing. So it's a process, and this process must be carried out by an independent person, and it's going to carry out this assessment on the record and the financial statement that is prepared by the entity, and at the end of the day, it has to arrive at an opinion as to whether the statement or the financial transaction or record represent the true and fairness of the dealings of the company. Now, in the definition, we have certain terms. One has to do with independent examination. Independent examination means the conduct of the audit should be carried out independent of the person who provided the records and the financial statement. Now, the work of the auditor should under no circumstance be influenced by the client. So here, the person who prepared the statement cannot be the same person who is coming to review it, who is coming to examine it. There has to be an independent person who is not the one who prepared the financial statement, and this person can carry out the independent examination. However, the person carry out the independent examination too, there should be no way that he can be influenced by the client. So he or she shouldn't be influenced by the client. In the definition, we look at a suitable qualified person. And what this means is that the auditor should be professionally qualified. He must have completed the approved professional accountancy examination, have the relevant skills, experience, and integrity to carry out the examination. So you should be qualified. It's not everybody at all that can be an auditor. You should be certified by a professional body. Now, another term is records and financial statement. Now, these include written authorization to effect the transactions, the source document, the books of prime entry, the ledgers, the trial balance, the profit or loss account, the balance sheet known as the statement of financial position, the cash flow statement, notes to the account, value added statement, director's report, and other reports issued in accordance with current corporate governance practice. So these are the records and financial statements that the qualified person is going to do the examination on. Now, after examining, he has to arrive at an opinion. And an opinion is the expression of the auditor's professional viewpoint about the financial statement after exercising his judgment, and based on the evidence gathered, he give an opinion. Now, he said he's going to give an opinion as to whether the financial records present or represent the true and fair dealings of the firm or of the client. Now, true and fair means that proper books of accounts have been kept. The financial statements are consistent with the underlying record. The financial statements have been prepared in accordance with acceptable accounting standards and relevant legislations. And the financial statements are free from material misstatement. The asset and liability shown in the book actually exist. They have properly valued and pertain to the entity, and then that all expenses and revenue stated relates to the operations of the business. When these are presented and disclosed, then we are saying that financial statements present the true and fair dealings of the client. Now, truth. When we say truth, what does it mean? Truth implies that The information is factual and conforms to reality with no material errors. It is not false, and in addition, the information conforms to the required standards and law. And fair means that the information is free from discrimination and bias and in compliance with expected standard and rules. So these are the definitions we have in the or the terms we have in the definition, and they have all been explained. Now, why the need for an audit? Why should you conduct an audit? So the management of a business or directors are obliged to report to the owners, who are the shareholders, on how their business has been managed. The owners at this point would like to assure themselves that the report contains no error, the report is not misleading, and the report disclose all relevant information. The reason being that the managers or the owners are not involved in the day-to-day running of the business. They have entrusted that to the directors, who then are the management. And management has to report to them at the end of certain period. And this report, they have to ensure that it contains no error, it's not misleading, and it discloses all the relevant information it has to disclose. Now, a way out of this problem of credibility in financial accounts and reporting is to appoint an independent person, referred to as an auditor. And this auditor has to investigate the report presented by management and then express an opinion on it. Financial statements are required to comply with the various legislations and standards, and compliance with these requirements can be assured if audit is carried out on the financial statement. So if the independent auditor goes and audit, his opinion will give some sort of assurance, credibility for others to rely on the report presented by management. Now, let's look at the objective and general principles governing an audit of financial statement. Objective of an audit. The objective of an audit of financial statements is to enable the auditor to express an opinion whether the financial statements are prepared in all material respects in accordance with an identified financial reporting framework. That is the objective, the main objective of the auditor. Express an opinion whether the financial statements are prepared and they conform in all material respects in accordance with the identified financial reporting framework. But aside it, he has some other subsidiary objectives, and these are to detect error and fraud, to prevent error and fraud, and to help the client to improve upon his accounting and internal control system. But one thing we need to understand here is that audit is not designed to identify errors, fraud, and significant weaknesses in the client system, but the audit work should be carried out in such a manner as to be able to unearth errors, frauds, and weaknesses if they exist. So these subsidiary objectives, they are not the core reason why you conduct an audit. But however, the audit should be carried out so that if there is any uh, chances that these subsidiary objectives are existing, the audit should be able to disclose or identify that and report on it. Now let's look at the scope of an audit. The term scope of an audit refers to the audit procedures deemed necessary in the circumstances to achieve the objective of the audit. The procedures required to conduct an audit in accordance with the IAS should be determined by the auditor, having regard for the requirements of the IAS, relevant professional bodies, legislations, regulations, and where appropriate, the terms of the audit engagement and the reporting requirements. Now let's look at certain terms. When we say professional skepticism, professional skepticism simply means that the auditor should perform the audit, plan and perform it with an attitude of professional skepticism that is recognizing that circumstances may exist that cause the financial statement to be materially misstated. And for this, it has to have a questioning mind throughout all the stages of the audit. It has to have a questioning mind, do what if analysis, go deep into details to find out why certain things are done this way. That is what we mean by professional skepticism. Now, reasonable assurance. An audit is designed to provide reasonable assurance that the financial statements taken as a whole are free from material misstatement. Reasonable assurance is a concept relating to the accumulation of the audit evidence necessary for the auditor to conclude that there is no material misstatement taken as a whole. And reasonable assurance relates to the whole audit process. So right from the planning stage to where you give your report, you need to ensure that you employ reasonable assurance and professional skepticism in all the procedures. Now, an auditor cannot obtain absolute assurance because there are inherent misstatements, and the limitations result from these factors such as the use of testing, the inherent limitation of internal control, that possibility of management collusion, and then the fact that most audit evidence is persuasive rather than conclusive. What we mean here is that the auditor cannot give absolute 100% assurance that things presented by the clients represent a true and fair view of their dealings. This is because they don't go and do absolute testing. They don't test everything. They only test on certain items, sample sizes. And then there could also be that there is some limitation when it comes to the internal controls. So they can't give absolute assurance, but rather a reasonable assurance because of chances of these errors and limitations. Now, let's look at audit risks and materiality. Audit risks and materiality. Now, the risk that the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated is known as audit risks. So you have audit risks, and it's a risk that the auditor may express an inappropriate audit opinion when the financial statements are materially misstated. Now, audit risk is a function of the risk of material misstatement of the financial statement, or simply the risk of material misstatement. That is, the risk that the financial statement are materially misstated prior to audit, and the risk that the auditor will not detect such misstatement. So there is a misstatement, but the auditor is not able to detect that during the process, and that is what we term as the audit risk. Now, the auditor considers the risks of material misstatement at two levels. So we have the overall financial statement level and in relation to class of transactions, account balances and disclosures, and the related assertions made by management. What are the responsibility for the financial statement? Who has the responsibility to prepare it? So while the auditor is responsible for forming and expressing an opinion on the financial statement, the responsibility for preparing and presenting fairly financial statement in accordance with the applicable financial reporting framework is that of management of the entity, with oversight from those charged with governance. So management has to prepare the financial statement, and then the auditor then comes to form an opinion. Now, the audit of the financial statement does not relieve management or those charged with governance of their responsibilities. Now, this happens because of, in order to ensure that there is an independent third party or professional coming to express the opinion. Management cannot prepare the report and be the same one auditing it. There has to be a different person altogether. Now let's look at the perspective when it comes to um, carrying out an audit. Now we look at it from the public sector perspective, that when carrying out an audit of the public sector entities, the auditor will need to take into account the specific requirements of any other relevant regulations, any ordinances or ministerial directives which affect the audit mandate, and any special auditing requirement, including the need to have regard to issues of national security. Now, irrespective of whether an audit is being conducted in the private or the public sector, the basic principles of auditing still remain the same. But what may differ for audits carried out in the public sector is that the audit objective and the scope might be different. Now, these factors are often attributable to differences in the audit mandate and then the legal requirement or the form of reports. For example, public sector entities may be required to prepare additional financial statements, but in the public sector, no. Now let's look at the advantages of an audit. Advantages of an audit. Now, audit is carried out to add credibility to the financial statement concerned and to assure stakeholders of the truth and fairness of the statement. Apart from the above advantages, there are inherent advantages in having accounts audited. Among them are the following. So one, we have disputes between partners may be largely avoided, especially when complicated profit sharing arrangements subsist. Then, changes in ownership is facilitated by an unqualified audit report. So it helps solve these problems. In addition, audited financial statements serve as a reliable source of information for banks and other financial institutions when it comes to assessing the strength of loan or overdraft applicants. In addition, audited accounts, as adjusted for tax purposes submitted to the GRA, carry greater authority than an audited account. Now, the presence of a qualified auditor is also useful because of the variety of other capabilities in which he or she is able to assist. So in the case of a company, the auditor can offer taxation and other ICT services to the firm. However, despite these numerous advantages, there are some drawbacks or disadvantages of an audit. One has to do with the payment of audit fees. Now, the auditors are not coming to uh, perform the audit free of charge. You have to pay them, and these are extra financial burdens on the entity. Now, auditing requires the client, staff, and management to provide information to the auditors, and this may sometimes cause a disruption for the free flow of what or the continuous process of the business operation. So at a point, the auditor will need this information, and then management has to pause whatever they are doing and then attend to them. So these are some of the drawbacks of auditing. Now let's look at the limitations of auditing. Now there are some limitations in what the auditors do. The auditor's opinion is neither a guarantee of the future viability of the entity, nor is it an assurance of management efficiency and effectiveness. The audit report doesn't guarantee the future liability and doesn't give assurance of management efficiency and effectiveness. Now, even though the auditor, in the course of the audit work, pays attention to both matters, neither of them represent the main purpose of the audit. And we look at the main objective of an audit. Now, an audit work is focused on examining financial records and statements relating to past transactions and the verification of assets and liabilities held by the client at the end of the relevant accounting period. So they are just assessing past transactions, not present or future ones. And there is also no guarantee or assurance from the auditors that what happened in the past will apply to the future. Auditors also do not conduct extensive review of what efficiency. They don't do that, and then they express an opinion, and then they do not satisfy whether a set of account is completely correct or not. Now, what we call reasonable assurance also depends largely on what a user of the financial statement expects from the auditor's report. So all these are limitations when it comes to the financial statement. Now, these limitations stem from the fact that it is not possible for the auditor to examine all items within an account balance or class of account. And there is also a possibility of collusion and misrepresentation for fraudulent purposes. And many audit evidence are persuasive, as we said, rather than conclusive. So these numerous limitations stem from these facts. Now, let's look at the other aspect, what we call the expectation gap. The expectation gap simply means that what the auditors do is different from what the users or the public presume the auditor has to do. Now, many people have some misconception about the role the auditors play and for what auditors or auditing is meant. Many are those who think that the auditor's report goes to the directors of the company but not the members. No. And some people also think that a qualified audit report is more useful to those who appoint the auditors than an unqualified audit report, and that is also a misconception. Then there is also the misconception that it is the auditor's duty to detect fraud, which is not supposed to be so. It is the responsibility of the directors to detect the fraud. Now, these misconceptions point to the fact that an expectation gap still exists between what auditors do and what people expect them to do. Let's look at the last aspect, which is talking about the structure of an audit firm. The structure of an audit firm. Now, audit firms have structured management. The partners generally delegate decisions of routine management to the senior partner, who reports to the full partnership at a regular convened meeting. The partnership secretary, reporting to the senior partner, takes responsibility for administration, including preparation of agenda papers and minutes of meeting, accounting and management records, word processing, etc. Now, the salaries paid to those involved in these activities form part of the firm's overhead. So when you take an accounting firm or audit firm, these are typically some of the things that goes on there. Now, the professional staff and partners maintain accurate time records to ensure that all items assigned to client affairs are properly billed and the appropriate hourly rate determined in turn by reference to what salaries. So in this way, the firm recovers salary cost of what professional staff and overhead. So there has to be record for their time spent with the client, the rate they are supposed to pay. Now, the excess of audit fees over this cost represent the partnership profit to be shared among the partners in their profit sharing ratio. So it's a partnership engagement, the audit firm that you see. And after taking their administrative cost from the revenue they generate, whatever is left is the profit, and that must be shared according to their profit and loss sharing ratio. Now, the professional staff are divided into departments. So you have taxation, those who are in charge of audit, those who are in charge of consultancy, those who are in charge of information technology, those who are in charge of account preparation services, liquidation, etc. and then we have seniority grades. So into department and seniority grades. Now, partners are made responsible for the service given to clients, and each of them is designated assignment partner, but the detailed management of each assignment is the work of the manager, who in turn take charge of the work teams of juniors and seniors within the broad departmental areas. So these are some of the, or this is how the structure of an audit firm is. Go through all these procedures. We have divisions, and each person is assigned what to do. So in summary, we've been able to look at the definition and objective of auditing, its advantages and disadvantages, the limitations, and the structure of an audit firm. We were looking at the other aspects of the nature, the definition, and then the scope of auditing. Thank you and see you in the next lecture.